Hello all, this is CA Muthurajan and I welcome you all to this seminar on accounting standards. So I thank Sivakasi branch for giving me this opportunity to take a session on accounting standards, and I also appreciate Sivakasi branch of ICA for organizing this seminar despite this COVID-19 situation for the benefit of students. So without wasting any further time, I quickly get into accounting standards. So before getting into accounting standards, I like to give you brief introductions why there is an accounting standard, why we need to study an accounting standard, follow an accounting standard when there are so many literatures in place. Here we will see today what is the introduction to accounting standards, objectives of introducing an accounting standards, and why we need to comply with accounting standard, who requires compliance with accounting standards, and what is international accounting standards and what is relevant in India. And we will see accounting standard 4, which is on events acquiring after the balance sheet date, and S19 on leases, S22 on deferred tax, AS24 on discontinuing operations, AS26 on intangible assets, and AS29 on contingencies, provisions and contingent liabilities. What is the objective of introducing an accounting standards and benefit of introducing an accounting standards? So just to see a standardization of alternate accounting treatment, I will tell you with an example in the next slide, and requirements for giving additional disclosures. What do you mean by additional disclosures? Which is this is most required for users of financial statements. Say for example, Jet Airways, you might know they are now not in operations, they are almost in liquidation. So we require users of who invested in Jet Airways to have know what will happen in the next 1 year. So whether auditors have disclosed or whether management has disclosed, given sufficient disclosure for the users to understand that Jet Airways will get liquidated in the next 1 year. So those disclosures are required by accounting standards, and more comparable. So I will tell you with an example again in the next slide how it helps in comparability. So where it's required to compliance with accounting standards, we have total 27 accounting standards in India. That is called Indian accounting standards. I will tell you other type of accounting standards which we have nowadays in India. So section 133 of the Companies Act 2013 requires compliance with accounting standards, and we have now a global accounting standard compliance with India. So we have a converged Indian standards which we try to cope up with the global standard, that is called Ind AS we call. So that is governed by companies Indian accounting standards rules 2015. So as I reiterate, 27 accounting standards are there. It is an Indian accounting standard. There are Ind AS, there are so many standards which is not part of our presentation today, so I am not getting into that now. So section 133 requires compliance with accounting standards of various companies which falls under Companies Act 2013. So just to have a look at this, so these two companies having a similar P&L, they have a sales of 10,000, but they have shown a different profit. So 2,190 and 2,350 rupees. So as a users of financial statement, when a person looking at company A and company B who is similar business, who generated similar revenue, wants to understand, treat this company as a poor company or as this company as a good company, whereas the situation is little different because the depreciation what he taken to P&L is 1,160 and this guy has taken 3,002. Why? If you analyze, go in depth and analyze, this guy follows different method of depreciation, this guy follows different method of accounting like depreciation. So in order to harmonize, in order to standardize the practice, so accounting standard was introduced. They introduced A6 and they told you are required to follow only WDV or SLM. You are not supposed to follow any other method of depreciation. So now whether difference will not come, if you ask me, yeah, difference will come, but you are within some limit. You are eligible to choose either WDV or SLM. So to some extent I can arrest the invariability in financial statements, so it will be comparable now. So not only depreciation for every area, say for example rent AS 19 got introduced, wherever there are uncomparable situations or wherever there is a required to standardize something, there is something called NFRA, National I will just tell you, National Financial Reporting Authority, they will support in introducing a new accounting standard wherever there is required. So MCA, Ministry of Company Affairs, will introduce accounting standard in consultation with NFRA, right? So some of the limitations or difficulty in making choices, say for example we are in Sivakasi, so we have a cracker industry which operate only 6 months or mainly operate only in 2 months towards Diwali, whereas the other months they are not in operations mainly or very minimal operations. So if you ask a fireworks industry to have a depreciation policy, how they charge depreciation, either they have to fall inside SLM or they have to fall inside WDV. So they don't have a scope, so every month they have to charge depreciation irrespective of whether they are in operation or not. So there are some difficulties which posed by accounting standard which are unavoidable, but authorities are working hard to remove all such kind of difficulties. So lack of flexibilities, as I told you first, again in fireworks industries, I don't have a flexibility. I want to comply with accounting standard, but I don't have a flexibility. Restricted scope, again as I told you, given an example of a cracker industry, I can play around with either WDV or SLM. I can't have any other methods. So again we are now in a scenario where we need to converge with the global and standards, because not only in India we should have a comparable financial statements, even in globally we should have a comparable financial statement. So we need to converge with the global standards like US, UK, etc. So there we have IFRS. We also are now complying with IFRS. We introduced a standard called Ind AS, which is a converged form of an IFRS. So we have given phase 1 and phase 2 of Ind AS for various listed companies. Still some small companies are still not covered under Ind AS. They are exempted from following Ind AS and they are required to follow only the Indian accounting standards, which we are going to see now. So this standards mainly deal with recognition, measurement and presentation and disclosures. So first standards we are going to see is AS4, which is contingencies and events occurring after the balance sheet date. So this standard mainly deals with what are the situations which arises after the balance sheet date, but before the board approves the financial statement. We will see what is the difference between balance sheet date, board approval date, on any other date. What are those different dates, how to comply with those dates, which events are covered under the standard, which events are not covered under the standards. So this standard deals with events acquiring after the balance sheet date. What is an event acquiring after the balance sheet date? So I have say for example I am paying a rent expenditure. I am closing the year end of March 2020. I closed. So now I have fixed my board meeting in September 10, 2020. Example, I am paying rent for April month. I am paying rent for May month. I am paying salary expenses for April month, May month to my employees. Are these significant events, or these are events occurring after the balance sheet date? Yeah, these are all event occurring after the balance sheet. So is it covered under this standard? What I am supposed to disclose in a salary or a rental expenditure which is paid? But to clarify, this standard covers only significant events. So significant event, rental expenditure or a salary expenditure is normal course of business. It is not considered as a significant event. So you should be very careful in seeing whether these are all significant events. It may be both favorable to you or unfavorable to you. It will be happening between balance sheet date, which is after 31st March 2020, and in my example before September 10 to 2020. So it's between the balance sheet date and the date on which the financial statements are approved by the board of directors. Again, please remember the word board of directors. There are different authorities approving the financial statements. Say for example, shareholders will approve the financial statement in an annual general meeting, which will happen after this board meeting. So once board of directors approved the financial statement, again shareholders will approve. That will happen on a different date. But this standard covers events between a balance sheet date and between the date on which the board has approved. In our example, it is September 10, 2020. The annual general meeting might happen on September 30, 2020. So we are supposed to cover events between April 1, 2020 to September 10, 2020 for a financial statements which is year ending on March 31st, 2020. So they are saying there are two kinds of events. One is adjusting event, one is non-adjusting event. So what do you mean by different events? Why these are all different events? Because adjusting, as the name itself suggests, adjusting, which means that there are further evidence or condition that existed at the balance sheet date which requires an adjustment to the balance sheet number which we are going to sign, or a debtor number or a fixed asset number. So this requires an adjustment. If this event happens, I have to adjust my fixed assets, or I have to adjust my inventory based on whatever event it is. These are all non-adjusting. Again, these are all called non-adjusting event. So this event doesn't require any adjustment to the financial statement. However, we are required to disclose these events. So as I told you, adjusting event, it gives additional information materially affecting the determination of the amount relating to condition existing at the balance sheet date. So if you want me to give an example, they already given an example, a trade receivables, a debtor died or a debtor becomes insolvent. Say for example, I have a debtor where I have to get 1 crore from a debtor, but due to unforeseen reasons, I could see him died, or I could see him in bankruptcy, insolvency. So this gives me an additional evidence to the fact that this 1 crore will not come. This 1 crore will not come, and accordingly I have to create provision for doubtful debts or propose an adjustment to the company, or management should assess themselves as an adjusting event and accordingly adjust that 1 crore as a bad debt in their books and accordingly decrease the debtor balances to that extent. So I hope you differentiate between what is an adjusting event and non-adjusting event. So non-adjusting event, again, it do not relate to condition existing at the balance sheet date. Here they are saying decline in the market value of investment. So decline in the market value, I think if you read AS 13, they will ask a permanent decline in the investment value. So just a decline in the market condition might require a disclosure, because you have to wait and see whether it is a permanent or it's a short term. So in order to make an impairment or reduce the investment value, you need to see whether for a non-trade investment or a long-term investment, you need to see whether it is a permanent decline in the value of investment. So just a decline after financial statement period doesn't warrant an adjustment to the investment value. So this is considered as a non-adjusting event. If you want me to say one more example, say for example, again I have invested more. So it is just an investing more, so it is just going to add the value of investment post my balance sheet date. It is not going to affect anything in my balance sheet. So it is just a non-adjusting event. So sometimes statutory regulation itself requires some disclosure. Say for example, the dividend proposed. So dividend proposed, they are saying though it happened in the board meeting, we have to just disclose it. So this is the event which is happening after the balance sheet. Board will see the financial statement and approve some 5% dividend, 10% dividend. So the events though happen between balance sheet date and the board meeting date. So these events are considered as a non-adjusting event and doesn't require any adjustment to the P&L, or you no need to record the dividend proposed. you have to record the dividend when it is declared. So declaration matters. So AGM it is declared, board meeting it is just approved, proposed. So these dividend has to be just disclosed in the financial statement, saying that the board has proposed this much dividends and will be paid in a due course. So also going concern, so what they are saying is additional matter apart from adjusting event or non-adjusting event, there is one more thing they are asking us to consider is whether these events are affecting our going concern. We are going to see with one example. Maybe I can take you through that example now itself. So what it says is there was a fire in the company or a warehouse. Which though not affected any of my products, it affects my production schedule. So it affects my production schedule. It might, I may not come back to industry itself, or I might not come back to business itself. You might see because of this COVID-19, many industries got affected, some industries got liquidated itself. So those industries they are talking about. So if there are going concern issues, if may it be a adjusting event or non-adjusting event, please ensure if going concern assumption got affected, it has to be disclosed properly in the financial statements, or the account should be prepared on a liquidation basis. So disclosure event or disclosure requirement, the disclosures made reporting opportunity, the nature of the event which you have considered as a significant, and whether you consider it as an adjusting event, non-adjusting event, and estimate of the financial effect. This has to be made in the approving authority apart from disclosing in the financial statements, which means board report. So I have given you some examples. So in X company, theft of cash of 5 lakhs by the cashier in January 2017 was deducted only in May 2017. This was a March 2017 accounts. So accounts of the company is not yet approved by the board. Whether the theft of cash has to be adjusted in the accounts of the company for the year ended 31/3/2017. So it happened in 2017. So the thing is that my cash balance actually it is less than 5 lakhs. So say for example my cash is 50 lakhs as per books, but actual cash present is only 45 lakhs. This cash got it was theft. So this is an adjusting event. Actually my cash balance is not 50 lakhs as at 31/3/2017, which is confirmed during May 2017. The company closed their books with 50 lakhs. So this is considered as an adjusting event, and 5 lakhs has to be adjusted to the cash balance. An earthquake destroyed a major warehouse of ACO Limited on 25/2017. The accounting year of the company ended on 31/3/2017. Accounts were approved on 36/2017. The loss from earthquake is estimated at 30 lakhs. State with reason whether the loss due to earthquake is an adjusting or non-adjusting event. How the fact of loss is to be disclosed by the company. So now, so we should be a little careful whether again if you ask me personally, this 30 lakhs will be an inventory loss or a fixed asset loss, whatever there in the warehouse. But this problem primarily deals with just an expense incurred, whether this expense has to be booked or not. So when they ask this expense to be booked or not, this is considered as a non-adjusting event. But however, we should really see whether inventory, any inventory which is stored in the warehouse got affected. If that is the case, so your inventory has to be valued accordingly. Say for example, you have 100 rupees worth inventory, 50 rupees worth inventory got gone in that fire accident, then you have to disclose your inventory at 50 rupees only, 100 minus 50. However, here the question says it is the loss of earthquake is estimated at 30 lakhs, so we are not required to consider this as an adjusting event, rather they consider this as a non-adjusting event. So please be careful in reading the questions. If something relating to the balance sheet got affected, then it becomes an adjusting event. But I believe this 30 lakhs doesn't have any of the items relating to balance sheet. It is just an additional loss, which means it's a non-adjusting event. There is no condition existing at the balance sheet date. However, you have to consider again going concern issue. This is the problem which I was talking about previously. So we have to consider going concern issues, if any. If there are going concern issues, we have to disclose those facts accordingly because of this fire accident. So again, a company has filed a legal suit against the debtor from whom 15 lakhs is recoverable as on 31/3/2017. The chances of recovery by way of legal suit are not good as per the legal opinion given by the council in April 2017. Can the company provide the full amount of 15 lakhs as provision for doubtful debts? Please discuss. So legal opinion itself says it came in April 2017. It's before board approval date. That was the assumption here, because they have not given any date of approval of financial statements. It's a March 30, 2017 accounts, so it's still not approved. April 2017, I got a confirmation from the lawyer saying that this debt will not come. So this is considered as an adjusting event because I have carrying that 15 lakhs in my balance sheet, which is considered as an adjusting event. Please adjust this 15 lakhs. So in exam point of view, we are supposed to discuss what is an adjusting event, what is a non-adjusting event, then you have to conclude. You cannot straight away conclude this is adjusting event, non-adjusting event. First you are supposed to write the definition of an adjusting event, definition of a non-adjusting event, and then you have to conclude. So there are a few more questions. In preparing the financial statement of R Limited for the year ended 31/3/2017, you come across the following information. State with reason how would you deal with this in the financial. Company invested 100 lakhs in April 2000 before approval of financial statement by the board of directors in the acquisition of another company doing similar business, negotiation for which had started during the year. A limited company closed its accounting year. This is the first problem. So here it is considered as a non-adjusting event. As I already told you, it is just an additional investment. Additional investment, there is no balance sheet effect. There is nothing there in the balance sheet which confirms here. It is an additional investment. So it is considered as a non-adjusting event which requires just a disclosure if it is material to the company, saying that this company, because always it is good to make the shareholders aware that the company has invested something, they are going for further investment, their business will be improving like that, etc., etc. So the next question on limited company closed its accounting year on 30/6/2017 and the accounts for that period were considered and approved by the board of directors on 20th August. The company was engaged in laying pipeline for an oil company deep beneath the earth. While doing the boring work on 1/9/2008, it had met a rocky surface for which it was estimated that there would be an extra cost to the tune of 80 lakhs. So they identified on 1/9/2017, whereas they have approved the financial statement already on 20th August 2017. So here is the case where I am outside the scope of this standard, because I have crossed the date on which I have to analyze my adjusting event or non-adjusting event, or I have to identify the event. But this, if it is happened before 20th August, I am supposed to recognize this 80 lakhs because it's considered as an onerous contract. The loss, like prudence concept, I have to recognize these losses immediately in the books because I have identified. But since it was identified August 1, like after August 20, we are not required to do that. So we no need to reopen the books, so we can close just like that. So the 80 lakhs will get accounted in 17/18. While preparing the final accounts for the year ended 31st March 2017, a company made a provision of bad debts at 5% of its total receivables. In the last week of February 2017, a trade receivable 2 lakhs was suffered a heavy loss due to an earthquake. The loss was not covered by any insurance policy. In April 2000, the trade receivable became bankrupt. Can the company provide a full loss? So it is very simple. Becomes a bankrupt, as usual it won't come to us. So we are required to fully provide for this 2 lakhs in the books of accounts by considering this as an adjusting event. Hope you don't have any questions. I have to move to AS22 So before moving to AS22, I'll take up AS19 actually. So AS19 on leases, so we'll take up AS19. So this standards as always, every standard has a objective, scopes, what is the provisions and disclosure requirements. So this standard will not apply to lease agreements to explore for use of natural resources, because that's a different guidance note which covers license agreement for items, motion picture films, recordings, plays, manuscripts, patents and copyrights, lease agreements to use lands, because these are all covered under different statutes and or different standards. So why? So again, this standards to be very brief, this standard covers finance lease, operating lease. So two types of leases this standard covers. One is finance lease and operating lease. So this standards requires us to identify whether the lease agreement which you entered into or finance lease or operating lease. Why it is really important? Because they are saying the accounting treatment itself differs, because this standard believes more of like substance or form. If you read Ind-AS, as I told you, the global standards, now they already moved to something called Ind-AS 116, which is deals with the lease, which always account, like if you say for example, if you cross 1 year, if you are entering into a lease agreement for more than 1 year, you have to record that lease arrangement as a your asset, which is considered as your asset, more than 1 year lease. So and if your rental is more than 5,000 rupees per month, so it is considered as significant lease and you are required to capitalize that building in your books. Capital means how will I capitalize, how much amount I should capitalize. So those things are dealt by this standard. So not this standard, so Ind-AS deals with that. This standard to some extent also deals with how to capitalize that asset in the books, because that is not my assets. So where is the invoice to capitalize those assets? So how to capitalize, we will see at what rate we have to capitalize. If I capitalize, what should I do with that asset? So what is the corresponding credit or debit goes to? So those things will be dealt by this standard. So this standard, as I told you, deals with two different. Operating lease, it's very simple. Finance lease, little detail we have to capture, because it is asking us to capitalize the asset. When I should consider it as a finance lease, when I should consider it as a operating lease, we will see. So when the lessor transfers the right to use an asset for a consideration. So this is a very simple concept. When a lessor means who is the owner of the property, transfers the right to use an asset to the lessee, which is for a consideration, then it is coming under this standard as a lease. It may be a building, it may be a car, it may be a chair, it may be a furniture, it may be a laptop, it may be a desktop, anything, like it may be a generator, etc., etc., anything. So transfer a right to use by a lessor to the lessee for a consideration, this standard will apply. So finance lease transfers substantially all the risk and rewards incident to ownership of an asset. What do you mean by substantially all the risk and reward? So when you transfer substantially all the risk and rewards incident to ownership of an asset, it is considered as a finance lease. So don't worry, I will take you through the in detail how to analyze finance lease. We have a checklist kind of thing in the next few slides, so we will see. So what is an operating lease? Whatever other than finance lease considered as an operating lease. Very simple example, very simple definition, sorry. So non-cancelable lease, which means very simple, both parties not able to cancel, but if you are cancelling, you have to pay some kind of penalty. Say for you might see in many agreements there are lock-in periods, those are called non-cancelable lease. So either it can be cancelable, either the lessee or lessor died, or you have to pay penalty and cancel it. So you can see many agreements having this clause of non-cancelable clause. Minimum lease payment is what you pay as a rent. So inception of the lease, what do you mean by inception of the lease? So earlier of lease agreement date, on the date of commitment by the parties to the principal provisions of the lease. So why it is important? So the standard requires us to classify whether it is a finance lease or operating lease by us analyzing the situation at the inception of the lease. Is it easy for me to classify operating lease or finance lease at the inception of the lease? Yeah, little bit judgmental. It is little bit difficult, because if you ask the company an asset worth 10 years old, like say for example I came to a building is a 30 years old, I have rented a building for next 5 years. So if you ask me whether in order to classify this building rent as a substantial, like a finance lease, I have to occupy this at least for a 29 years period, then only you have transferred me substantially. I have using this premises substantially for me whole of this asset period, like 30 years. So if you ask me at the inception, can I decide whether it is a finance lease or operating lease? It is very difficult. I don't have any information. I have to classify this as an operating lease only, because you should have some information at the inception of the lease to make you to decide whether it is an operating lease or finance lease based on the conditions which is prescribed in this standard. So lease term means it's a non-cancelable period. It's a non-cancelable period, plus if the lessee has an option, please be careful, if for which lessee has agreed to take on lease of the asset, but if you read the standard, one more plus a further period if a lessee has a right to renew it. So management will know. If you see, why I am saying is all non-cancelable period is very easy to take, whether you like or not you have to pay rent. So you are very comfortable, you can decide that is a lease term. But plus if lessee has an option to renew, that period also should be considered. So in my example of building of 30 years old, building will be 30 years, useful life will be there. So if you are renting that building for 10 years, you are supposed to see whether the lessee will renew for another 20 years. But how you conclude whether he will renew or not? You can see the infrastructure you have. Say for example, I have seen audit firms install so much infrastructures where video conferencing facilities, the sophisticated furnitures, sophisticated interiors. So you can't just like that move after 10 years. These are all interiors which you have seen that building to occupy in the long run as well. So in those cases I can see or I can sense that management will be there for next 30 years, whereas the lease agreement should also give levy to the lessee to decide. Lessee, not a lessor, it's a lessee should decide. Lessee should have an option to renew it. If there is an option to renew it, lessor should agree it. So those kind of situation, it not only non-cancelable period, if you read the standard, non-cancelable period plus any terms which a lessee has an option to renew, those is called lease terms. So fair value, an amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties in an arm's length transactions. So it's not a related party transactions, there are some external parties who can exchange for an arm's length price. Economic life, I will give you a simple example of an economic life. As I told you a building example, economic life is 30 years, whereas useful life is 10 years, meaning if you vacated the premises, one more user will come, 10. So 3 users might come. So three users put together called economic life, whereas useful life is what you have occupied that asset, how much period you are going to use that asset, that is called useful life. Residual value, it is very simple, it's a gross investment. So all these definitions you be please remember or please read the standard. So these are all very simple definitions. Maybe these definitions are useful for you to determine how much amount to be capitalized, etc., etc. This definition we have already seen. Classifications again, finance lease and operating lease. As I told you, the standard relies mostly on substance of a transaction rather than just a legal form. Legal form is that just you have rented the building, but substance over form is that you are going to occupy that building for entire 30 years. So why should a lessor capitalize that building in their books? The standard requires a lessor to de-recognize that asset in their books and just to show as a receivables from the lessee, whereas the lessor has to capitalize that building in their books, because substance or form, that building for the entire life is going to be with the lessor. So how to determine a finance lease? The ownership transfer at the end of the lease term. The agreement should have an option of transferring. Say in my building example, after 10 years itself, if the building is getting transferred to lessee's name at a very low consideration, then it is a finance lease. It's a bargain purchase option. Lease for majority of the economic life. So as I told you in my example, 30 years if the lessee is occupying this building, then it is a finance lease. The present value of MLP. The present value of MLP amounts to at least substantially all of fair value of the leased assets. So what they are trying to say is, in my example of, if you put 30 years rent for a building, but you are able to pay that entire 30 years rent in the 10 years itself, or the building cost 10 crore, which you are going to pay that rental in 1 year itself. So the lessor able to collect from you the entire 1 crore worth or 10 crore worth money from you within 1 year, then again that is considered as a finance lease, because he is almost collected his entire money what he is invested in the building. This is a peculiar case, lease asset of a special nature. Say for example, you are a fireworks industries where say for example you would have seen fireworks industries building where all 4 sides are open or any. So those are all specific in nature. Maybe if you see Foxconn, who is a supplier for Apple products, so when they supply Apple products like Apple panels, so there will be trays which are rented from a lessor. So those trays are very, very particular for the Apple the back covers. So you can keep only Apple back cover, you can't keep anything else. So those assets are very, very specific to the vendors or the customer. So those specific designs I can't rent it to anyone else. So those cases we have to consider it as a finance lease. Cancellation losses borne by the lessee. Changes in the fair value of residual borne by the lessee. Bargain lease renewal options. These options are present, so you have to consider this as a finance lease. Again, it's very simple. Accounting treatment in the lessee books. In case of operating lease, please be careful. It is in case of operating lease, the asset will be continued to be shown in the books of lessor. Lessee is going to see as a payable of rent. If it is a prepaid rent, it's already paid for 6 months or 7 months, then you can show us as a prepaid. Otherwise it's a payable, lease rent payable. You have to P&L should show lease rental expenditure. Here lessor will show depreciation expenses and lease rental income. So disclosure requirements again we'll see in further slides also, so I'll just move on from here. So disclosure requirement for an operating lease, we are supposed to disclose in the financial statement how much you charge it to P&L. And one more thing, they say it is straight line basis, so you are supposed to do a straight line basis. I will give you an example for a straight line basis. Suppose say for example you are paying rent of 100 for first year, second year 110 and 120 for the third year, and you are in a lock-in period. The standard requires you to accrue 110 throughout the 10 years. It's called straight line. I will maybe explain you with an example in the next slide. So one more disclosure requirement is not later than 1 year, later than 1 year, and not later than 5 years, and later than 5 years. What are the lease payments you are going to make for not later than next 1 year, 1 year to 5 years, and greater than 5 years. So lessor, as I told you, carries as like a fixed asset. He will charge depreciation. He will consider whatever lease rental you are paying as an income in his books. So this is the straight lining. As I told you, straight lining. So company has leases equipment for a 4 years lease. The lease payments are to be made as follows: year 1 1 lakh, year 2 1 lakh 50, 1 lakh 75, and year 4 2 lakhs. So total rent of 6 lakh 25. The cost of the equipment is 15 lakhs and useful life is 10 years. The lessee is classified as a operating lease because I am going to occupy only 4 years out of 10 years. So hence equalization of lease on straight line basis is 1,56,250. So what will happen on year 1 between this 1 lakh, because I am going to pay actual rent of 1 lakh, whereas the standard asked me to accrue 1,56,250 as a rental expenditure. So what will happen to this 56,250 and when will it get reversed? So here is the answer for you. The rental expenditure should be booked as 1,56,250. The cash actually I am going to pay is 1 lakh, whereas the remaining, the difference, I have to take it to operating lease payable or a lease equalization reserve. The more appropriate manner to say is lease equalization reserve. So this reserves gets accumulated. So year 1 it will get accumulated, year 2 it will get accumulated because it's 1,50,000 and it is 1,56,250. From year 3 onwards it will start reversing. The lease equalization reserve will start reversing. So it will start reversing. So in the books of lessor he will say income operating lease receivable of 56,250, rental income. He is also required to do straight lining. So for him the same entry will come. For him, in addition, he will charge depreciation because he follows 10 years depreciation. After 4 years, some other lessee will take up this asset. So in the books of lessee, in case of finance lease, in case of lessee, please be careful. In case of lessee, it's as a leased asset, and he will also create a liability for his payments, and he will, since he recognized an asset, he will charge depreciation, and he has a financing component will considered as a finance expenses. We'll see how he is going to do it. In the books of lessor, it is, as I told you, receivable profit on sale, because on day 1 itself you have to consider this is a sale of asset. So you have to recognize profit on sale, the difference between the cost you incur to purchase that asset and the present value of gross investment, and you have to consider each income from the lessee as a finance income. So why capitalize? As I told you, account the present transaction not merely by legal forms. The standard says substance over form and not merely go by legal form. So this standard asking as to capitalize. So no legal title to the leased asset, but lessee acquires the economic benefits. Though I don't have a title to that asset, but I enjoy the entire economic benefits which is coming out of that asset. The obligation approximately represents, so again whatever is the listing which we see for categorizing this as a finance lease only again repeated here. So you can see how to account for in the lessee books and also lessor books. So lessee books, the asset lease term is 3 years, economic useful life is 3 years. When I say economic useful life, the entire asset useful life itself 3 years. When you say What is that one more useful life which we saw? Just a useful life. Economic useful life is different, just useful life is different. Useful life is just an lessee's that asset's useful life. Economic life is an entire useful life of that asset. So fair value is 2,35,500, which is the cost of the asset. The lease payments is 1 lakh at the end of every year. Residual value is 3,500. Guaranteed residual value is 17,000. So you have to remember this formula. This is a formula which will allows you to calculate what is the fair value of the asset. So according to the above formula, you will be now finding it over interest rate, which you have to, as I told you, you have to consider as a finance expenses. For this, you are required to compute what is the interest rate to charge on the principal amount. So you have computed based on the above formula. It is in the standard. You can refer the standard for the formula. So once you apply this formula, you will be able to get 16% interest rate, and accordingly your asset and liability will be recorded at 2,35,500. The depreciation will be charged as per the policy, which is the 3 years policy. So you can see from here, finance charge, how that 37,680 came. 2,35,500 into 16%. So the remaining will be you have to reduce from the liability. So this is on the liability portion. Asset portion, you will straight line over 3 years as a depreciation, right? So this you have to account as a finance expenses. This is just a reduction in the liability. So this is how your accounting entries flow. Clear? So you can see the accounting entries here. It's very simple. It is just straight lining of divide by 3, and your lease liabilities you are paying this much, whereas one portion goes to interest and one portion goes to the liability, reduction against the liability. Same way for finance lease as well, same disclosure is required, not later than 1 year, 1 year and not later than 5 years, and greater than 5 years. The same accounting entry follows in lessor books as well. Okay, so same entry follows in lessor books as well. So summary, the lease is classified either as an operating lease or finance lease, and classification depends on whether substantially all the risk and rewards have been transferred. So based on that you will classify. No bright lines. Classification made at the inception of the lease, as I told you. This is not relevant for us. So lessor books, I am not going in detail. Maybe if you have any doubts, you can contact me. At the end of this section, I will be sharing my contact details. Please, it is there in the presentation itself. If you have any doubts in the lessor books, please you can just mail me or call me anytime. So I'll be able to support in answering this. Hope you are clear on AS 19. So just to reiterate, this standard mainly focuses on operating lease and finance lease. If finance lease conditions are satisfied, please classify this as a finance lease. So only difference between operating and finance lease: operating lease, you continue to charge that lease expenditure as an expense. So only more concept is just a straight lining you have to follow. In case of finance lease, you lessee capitalize the asset, how to capitalize the asset, you have to take a present value of minimum lease payment. So based on that you will capitalize. You can go through the sums in the study materials. If you have any doubts, please call me anytime. So the asset is capitalized in the lessee books. So the whatever assets capitalized in the lessee books has to be depreciated based on the estimated useful life of that leased asset. And the liabilities portion which you recognized has to split into financing component and principal component. So finance component, how to calculate the implicit rate of return. How to calculate implicit rate of return? There is a formula given in the standard. Using that formula, please calculate the implicit rate of return, and that rate you have to apply and compute the finance expenses to be recognized. So in case of lessee books, depreciation will come against the asset capitalized, against liability which is recognized. You have finance income and reduction in the liability. In case of lessor books, it will be shown as receivable on day one, and you have to recognize the profit or sale on profit or loss on sale of asset. You have to recognize on day one, and you continue to recognize the finance income based like same rate you have to use 16%. In our example it was 16%. So next standard is a third standard. Out of 6 standards, we are in third standard now, which is AS 22, accounting for taxes on income. So this is actually my favorite standard. Though I do mostly statutory audit, I like mostly taxes. So I like this standard because this standard deals with doing reconciliation of effective tax rate, etc. So I wherever there are problem in effective tax reconciliation, people used to call me for reconciling their deferred tax, because I will tell you what is an effective tax reconciliation. Without any further delay, I'll just go inside the standards. So this standard has few definitions. Deferred tax is nothing but just a prepaid tax or a tax which is not paid in time, so you have to accrue it. So that is called deferment. So deferment name itself suggests. So we'll see in detail now. So so why there is a deferred tax? So what about this deferred tax? I have goods and service tax, I have income tax. So what is this deferred tax? Is it it is a part of income tax, I could say. It is just an income tax which, because of timing differences, which means I am supposed to pay in 1 year, but I am paying in some other year. Because of that, in order to capture those what I can say is, in order to have a matching concept, this standard came into place. So I will just give you a definition of and briefly explain what is deferred tax. So accounting income and taxable income. So what is the difference? We will see in future slide or in the coming slides what is an accounting income, what is a taxable income, why these two incomes actually matters, why there are differences. Is there any difference between accounting income and taxable income? Yes, there are differences, because accounting income gone by Companies Act, taxable income gone by income tax law. So this is tax accounts, this is income tax. So is that accounts itself different? No, it is not different. It is there some kind of adjustment. Most of you would have seen in your firm where you do articles, you would have done an income tax computation where there are some expenditure allowed under, not allowed under income tax, not allowed under income tax. Example, bonus. I accrued for 100 rupees bonus. Those bonus are not allowed under the Income Tax Act. Why? Because it is section 43B says bonus payments are allowed only on payment, like leave encashment allowed only on payment, like interest on loans allowed only on payments. So those, but my Companies Act, I have to follow accrual concept, so I have to accrue for bonus. Say for example, depreciation, I follow depreciation on SLM basis, WDV basis, useful life I adopt whatever I want, but income tax follows just WDV, and you are strictly required to follow the useful life what is given under this appendix 1. So because of those differences are there. So accounting income and taxable income. So permanent difference, what is a permanent difference? So there are timing differences, the permanent difference. In case of my example, the bonus is called timing difference. If you ask me what is the example of a permanent difference, example a share capital. So if you are issuing a share capital, further issue of share capital, I have to increase, I hope all of you are aware that there are authorized share capital, issued share capital, paid up capital, etc. So if you are going for an additional issue of share capital, now you are required to increase your authorized share capital as well. In order to increase your authorized share capital, you have to make some payment, like payment to Ministry of Company Affairs, so that you can increase your authorized share capital, and you also incur some of the expenditure to auditors, to lawyers in connection with the issue of share capital. So these expenditure, though it is charged to P&L as a legal profit and loss account, as a legal and professional expenditure, under the income tax, this is considered as a capital expenditure in nature, and it is not allowed by the income tax at all. So you cannot claim any time. Say in my example of bonus, you can claim when you are making a payment, but in my example of the legal and professional incurred in connection with additional issue of share capital, you cannot claim it. It is not allowed any time. So it is a permanent difference. So what is tax expenses? Tax expenses in the profit and loss account is current tax plus income tax. Current tax and deferred tax. So a tax expense in P&L means current tax versus deferred tax. Current tax will come whatever on taxable income, whereas deferred tax will come, the difference between accounting income and taxable income is considered or split into timing difference, permanent difference and timing difference. So timing difference, I have to create deferred tax, whereas taxable income, I just create a income tax. So just to clarify, there is an accounting income, there is taxable income. So there are some differences. So what are you going to do with the differences? You will again come and analyze whether it is a permanent difference or timing difference. If it is a timing difference, you will create a deferred tax expense or deferred tax income, whereas in the balance sheet it will stay as deferred tax asset or deferred tax liability based on your situation, based on your type of timing difference. So you classify the difference between timing difference and permanent difference. Permanent difference, no need to do anything, it is a difference, that's it. So timing difference, you have to create deferred tax asset or deferred tax income. When you create deferred tax income, you have already paid tax. Example, bonus, you are going to pay already, you are going because it is disallowed under income tax. Now your profit will be more, your expense is not recognized under income tax, so your profit will be more than what you disclosed under income tax. Because of which, what are you going to do? Your profit under income tax will be more, you will be going to pay more tax. Instead of paying 50 rupees tax, you are supposed to pay 100 rupees tax. So the 50, because of timing difference, the bonus example, timing difference, you have to recognize as a deferred income when it is actually paid, when actually allowed under income tax act. So you will be reversing the deferred tax income what you recognize, deferred tax asset what you recognize. So that is how it works. In simple, if something is allowed under income tax act, you have to create a deferred tax liability. If something is not allowed, you have to create a deferred tax asset. So again, I am giving you an example. This is accounts P&L, that is tax P&L. You can see the differences. The differences here. Depreciation, because income tax we follow different depreciation method, whereas the depreciation under income accounts is different. Expenses 1200, 1000. Why? As I told you in my example, bonus of 200 is not allowed because I still not paid. It is not allowed under section 43B. So here I have given a reconciliation. So say for example, as per accounts, so there should be a matching concept. As per accounts, my profit is 2190. So standard says I don't care if your P&L says 2190, there should be a matching concept. Tax rate is 10%, you should have in the P&L 219 rupees. But what happens, because my profit is only 550 as per income tax, I am supposed to pay only 550 here, just a correction. So because my profit is 550 here, I am supposed to pay a tax of only 55. So what will happen to the differences of 219 and 55? It is recognized as a deferred tax. So you can see deferred tax of 164 by and 155 gives 219. So how this 164 comes? Because there is a deferred tax difference of 184 on depreciation. Example, depreciation allowed under income tax is 3000. Depreciation allowed under income tax is 3000. Depreciation allowed under books is only recorded in books is only 1160. So income tax has allowed extra, which means I have to create a deferred tax liability or a deferred tax expense 184. Whereas if you see the expense, the income tax has not allowed 200 rupees, whereas I believe this 200 will be allowed as a deduction some point in time later. Because of this 200, I have to pay more tax. So I have created a prepaid tax, which is a deferred tax income. So deferred tax on expense 20, I have created a negative, which means income prepaid. So the net number is 164. So as I told you, as I like to do effective tax reconciliation, here is the answer. 2190 is my book profit. Because the standard says if I add any time current tax plus deferred tax, it is a total tax expenses in the financial statement, which I should get 219. How I am getting this 219? 55, which is tax as per income tax accounts, plus 164, which is a deferred tax. How that 164 comes? There are so many components of deferred tax. One is because of depreciation timing difference, one is because of expense timing difference. In my case, it is bonus. So other points relating to deferred tax assets. So prudence while recognizing deferred tax assets, as it is a simple concept where standard says accounts, wherever we go it says we have to follow prudence. So before recognizing some income, you should be prudent. In my example of bonus, you should be prudent. Whether are you going to make the payment? Do you have enough money to pay this bonus in the future? Whether you will be able to pay the bonus in future, then you can recognize the deferred tax assets. One more thing, I think you all aware that there can, if there is a book loss, say for example, in this situation 2190 is a loss. So as per income tax, you can carry forward this loss to the future. So what happens because of carry forward? Because of carry forward, you are not going to pay tax in the future for the taxable income you earn. So if 2190 is loss, assume for a moment is for income tax purposes itself, 2190. This 2190 can be carried forward. Say for example, next year you are earning 5000 rupees as income, you can reduce this 2190 and you can pay only to the extent of 2810 rupees only you will pay tax, though you earn 5000 rupees as profit. So what happens? You pay tax on only 2890. You have to recognize you are earning an asset. So deferred tax asset has to be recognized on losses, carry forward of losses. Since this is a benefit you are going to get in future, you can create a deferred tax asset on losses incurred by you, taxable losses incurred by you. So any business loss or depreciation loss, you can create a deferred tax asset, but the standard says please follow prudence. And in case of loss scenario, as I told you, deferred tax can be created on business losses, carry forward of business losses, you have to have a virtual certainty. Then only you should recognize deferred tax asset. What do you mean by virtual certainty? Virtual certainty is something very sure. You should be very sure, which means in case of our lease standard, I have told you there is a lock-in period. So though suppose a lessee cancels his lease agreement before the lock-in period, he is supposed to pay you the rental money. Though he cancelled, he has to pay the rental income, or he has to pay the fine penalty. So anyway you are going to get that amount from him. So I am very sure that I will get that lease income. So there is no second thought or no issues in getting that money. So that is called virtual certainty. What do you mean by reasonable certainty? I have a lease agreement. I don't have a non-cancelable clause, but I have an agreement. So that is called reasonable certainty. When there is a non-cancelable clause and you are very sure that you will be getting that money, then that is virtual certainty. So in order to recognize a deferred tax asset on a business loss, you should have a virtual certainty. Reassessment of unrecognized deferred taxes. So whenever there are, as I told you, when you not recognize the deferred tax because of prudence concept, that you don't believe that you will generate a taxable income in future, because of that whatever losses you incurred this year, you have not created a deferred tax asset. So next year you have to reassess whether this year situation changes, whether the management will be able to make profits in the future, in the near future, like that. So you have to reassess. If you believe that management will generate profit in the near future, then you can recognize the unrecognized deferred tax asset which is left in the past. And review again, review of recognized deferred taxes, which means, so you recognize the deferred tax, you had virtual certainty, you recognize deferred tax, but the situation changes for some reasons, for some whatsoever hypothetical reasons, you are not able to generate profit. So you have to review the deferred tax asset recognized every year. In case you feel that this deferred tax asset cannot be recognized in future, you have to impair it, or you have to reverse it. Measurement at what rate? So what rate? Current tax can be, all Income Tax Act, every year the finance minister gives the income tax rates. So current tax will be at that rate, whereas the deferred tax is for future. So as I told you, deferred tax is for future. The deferred tax rate also using the rate which is substantially enacted on the date of balance sheet date or on the date of approving the financial statements. So you should recognize deferred tax because it is going to reverse in future. Current tax is going to be paid this year, whereas deferred tax is going to get adjusted in the future. You have to recognize deferred tax using the rate which is substantially enacted on the date of balance sheet date or on the date of approving the financial statements. Suppose, say for example, the company pays minimum alternative tax, which is at a lower rate. Normally income tax rate will be 30 plus surcharge plus cess, etc. Whereas if you go for MAT, some minimum alternate tax, I think most of you know what is minimum alternative tax, which is minimum. So the income tax authority is asking us to pay minimum amount of tax, though you are in loss. As per tax you are lost, but as per books of accounts, for some reasons you have earned a profit. So those cases you will charge a minimum alternative tax which will be lesser than the normal tax rate, which is 18%. So in those case scenario, should I go for 18% deferred tax or normal rate? The standard says you have to recognize deferred tax at normal rate, though you are under MAT for next 3 years or 4 years. So disclosure requirement, you are supposed to disclose how much current tax and deferred tax, what are the components. As I told you, like we have seen in our example, we have recognized deferred tax on depreciation, we have recognized deferred tax on expenses. So you have to show the components from where and all you have got a timing differences and how you recognize. So if you recognize deferred tax on losses asset on losses, you are supposed to disclose in the financial statement how management is comfortable, and for earning the taxable profit in the future, how they are going to set off in the future. What is the business management have to make future as a profit and set off against this deferred tax asset. Separate disclosures, so you have to disclose in case of consolidated financial statement. If one company have deferred tax liability, one company have deferred tax asset, you don't have a legal right to set off. You have to separately disclose the deferred tax liability separately, deferred tax asset separately. However, as a company, you can show a net position if you have a legal enforceable right to set off those deferred taxes. So as I'm telling you, in case of similar company or same company, you can different components can be clubbed and shown in the balance sheet as a net position, whereas in case of consolidated financial statement, if one company has deferred tax asset, one company has a deferred tax liability, both has to be separately shown. It cannot be netted off. So Rama Limited, I am just giving an example. These are all questions from your book. Depreciation as per accounting records 2000, depreciation as per income tax records 5000. So here income tax allows more. So accounting records, it is booked less. So if they allow more, I have to pay less tax, which means I have to create a deferred tax liability. Right, something allowed. So simple concept which people taught me was, under deferred tax, please close your eyes and say if something is allowed under income tax as per you, more allowed, then it's a deferred tax liability. If something is not allowed, then it's a deferred tax asset. So in case here the under income tax it is allowed more, so please create a deferred tax liability. But if you go work out and see, because they allowed more, I'll be having less taxable income, and because of less taxable income I am going to pay less tax. But my book shows only 2 lakhs as depreciation, I have to pay more tax. So in order to, I have to go by books only, so I have to match the books. I create a deferred tax liability. Whereas unamortized preliminary expenses, the rule under income tax for unamortized preliminary expenses is that over the period of 5 years. So this is not allowed, this is disallowed under income tax. After disallowing, it will be allowed over the period of 5 years. So I created deferred tax asset because it is not allowed. So again, same example only. I'm not going through this example again. So this I have not spoke about today. Maybe I can just touch upon what about tax holiday. So you may seen or you may aware there are companies which are getting tax holiday, like companies in SEZ zone or EOU zone gets exemption of no need to pay tax for next 10 years. So if they no need to pay tax, whether I need to create a deferred tax asset or liability or not, it's a question which arises. So the answer to this is, the standard says if any timing differences which is not getting reversed, say for example bonus, it will be 1 year you will create, next year Diwali you will pay. So this is getting reversed. But something is not getting reversed. Say I can give not getting reversed is gratuity. There is a gratuity expenses which is due only on employee's retirement or resignation. So the employee will resign after 12 years, 13 years, etc. But gratuity fund will be there in the company forever. So whenever employee resigns, you will pay. You don't pay like bonus for all employees. So whoever resigns only you will pay. So gratuity is a typical example of timing differences, again gratuity expense is also allowed only on payment basis. So gratuity expense is one of the typical example for not expenses not getting reversed within the tax holiday period. One more example I can give is depreciation. You are supposed to calculate 10 years depreciation under Income Tax Act, under accounts. So 10 years you have to see any differences which is not getting reversed within the tax holiday period, but I don't think so they will give some for you under this concept, because you have to work out very detailed. So please remember only the concept. So the concept is any timing differences which is not getting reversed within the tax holiday period, you are required to create deferred tax asset or liability, depends on the situation. So again, one more problem here is that how to do a transitional adjustment. What do you mean by transitional adjustment? Means when I adopt the deferred tax standard for the first time, you are supposed to see how to adjust the deferred tax, how to recognize deferred tax. So unrecognized deferred tax till date has to be recognized first through the reserves, revenue reserves, not to the P&L. So opening whatever deferred tax you have not recognized, first year when you are implementing the standard, the timing differences should go to revenue reserves. Then the going forward you can charge the deferred tax expense to the P&L. So again, it is very simple examples. Accounting income, because they follow percentage of completion basis, whereas tax they don't follow. We follow AS7, whereas tax doesn't follow AS7. So you have a difference in the revenue recognized, 11 lakhs, 7 lakhs. So revenue as per, so I am showing more revenue, whereas taxable income shows less revenue. It is a deferred tax liability. You keep recognizing deferred tax liability, but when you start recognizing more like less than taxable income, this deferred tax liability will start reversing and coming. Again, it's very simple examples. If you want to do a matching concept, you can see the tax rate is I think 40%, so 80,000. So you can see this alone 80% tax, 40% tax, 40% tax. This two if you include 40%. So 40% always should match. The only difference is that current tax one and deferred tax is remaining. So in case of loss scenario, you have only deferred taxes, and in case of loss scenario, as I told you, it will carry forward and reverse your already recognized deferred tax asset. So you now just started generating profit, now you will reverse your deferred tax asset. When it comes to next year, I have balance 40,000, I am coming here and reversing this again, the balance 40,000 and recognize for the current like balance is current tax. So always I will match 40%. If you total here 40%, 40% and 40% will come. So discontinuing operations. So this standard is very simple standard. I don't see any problems which is coming out of the standard. Why it is relevant? What is this relevance of the standard? Is this standard basically asking us to show discontinuing operation? What do you mean by why it is relevant to show discontinuing operation? The name suggests it's discontinuing. Something discontinued, it is useful for the users of the financial statements. Say for example, in case of Nissan, which manufactures car, so I have manufactured everything in-house. Sometimes I'm planned to shift my producing engine. I'm not going to produce engine. I'm going to separately form a company called engine division and going to purchase from that company engine alone. So that is called discontinuing operation. I discontinued. So you have to have a judgment in place whether to consider that there is a very thin difference between a discontinuing operation and modifying your operations. So you have to see when to conclude as a discontinuing operations. So one more example I can give you as like A17, you would have seen a segment reporting. I have various segments. Say for example, if you take example of a standard, they have school, they have colleges, they have fireworks. So if they discontinued school, they want to going to sell it to someone else, then it's called a discontinued operation. The school division of the standard, say for example, there is a standard private limited, under that there is school comes, college comes, fireworks comes, etc. So you are going to leave the school alone to someone else, then that is called discontinued operation. You have to disclose whatever disclose requirements which is required under the standards. So this standard requires us to disclose something about this discontinuing operation, so that the users of financial statements are well informed to take decision whether to invest further or withdraw their investment, etc., etc. So this standard requires us to something called initial disclosure event, when to identify this event. So this standards basically asking us to identify when the trigger of the initial event or discontinuing operation begins, which is called initial disclosure event. So you can go through this list. They are saying the company has formally approved a detailed formal plan for the discontinuance, which means the discontinuing operation started. So you are supposed to give an initial disclosure. This is called initial disclosure. You are supposed to disclose these initial disclosure when you are triggered with this initial disclosure event. So initial disclosure event means the company started a binding sale agreement, the board of directors approved a detailed plans, like this, they identified the major asset, expected method of disclosure, period expected to required. So all these are already decided by the management, which means the discontinuing operation is already in place. The management is supposed to disclose in their financial statement that there is an decision by the management to discontinue something. So one is called initial disclosure, and next is called updating the disclosure. When it formally happens, so what are the disclosure I have to give in my profit and loss account, balance sheet, and financial statement, and cash flow statement, etc. So this standard is more about the disclosures. So only thing is that how to identify a discontinuing operation, it will be little challenging. Maybe if not from the exam point of view, they will clearly say this is the discontinuing operation, but you have to be very careful. They say that not only segments, even a company as a whole, as I told you, an engine division is moved out. So whether that to be considered as a discontinuing operations, again you have to be very careful. They have given a definition what is a discontinuing operation. You have to fill as a checklist, and if all conditions are satisfied, then you have to consider that as a discontinuing operation. So other disclosure requirement, pre-tax income of the discontinuing operation should be shown separately. Income tax on this discontinuing operation to be shown separately. Gain or loss on disposal of component and income tax thereon should be shown separately. The selling price range, what you agreed with the customer, should be shown separately. And updating the disclosures, you keep updating, because the discontinuing is an operation might not happen on a single year, it might happen every year. So you keep updating the disclosures, these disclosures, and separate disclosure for each discontinuing operation. In my example, if I say school, if you give up colleges also, then you have to shown as a two separate discontinuing operation disclosure. so you have to show us two separate disclosures, and there is requirement for prior period, even the prior period also to be updated, even prior period also to be separately disclosed. You have to restate the prior period as well. So that's all from the discontinuing operations. And AS 26, intangible assets. So what do you mean by intangible assets? Basically the funda from this standard is how to recognize, how to identify a asset as an intangible asset, what is the maximum depreciation policy which is allowed for an intangible asset, if it is an in-house generated intangible asset, what are the costs which can be capitalized, not capitalized, what are the rules for internally generated goodwill, and what are the intangibles covered under the standards, how to recognize the intangible asset, when to actually see this is an intangible asset. So this standard says this standard doesn't cover actually. So whenever there are scope, there is a negative scope in all standards. Intangible asset sale in the ordinary course of business, which is considered as an inventory. Say for example, Microsoft, they say sell softwares. For them, intangible assets are not softwares are not intangibles, their softwares are inventory for them. Deferred tax, why they consider here is that they say intangible means no physical substance. So is that deferred tax asset is also an asset with no physical substance, which is not covered under the standards. It is covered under AS 22. Lease, which fall under AS 19. Again lease of softwares, so again covered under AS 19. Goodwill arising on amalgamation and consolidation. Financial assets, mineral rights and expenditure. So all these are covered under different respective standards. So amortization, active market. So amortization is nothing but the depreciation of intangible assets. The name is just different. Active market means they say for impairment loss. If I want to have we'll see what is impairment loss. If I want to make an impairment loss, I have to identify the selling price in an active market. Active market means you are able to get a buyer and seller easily without any much efforts. So fair value, which we have seen in the already the other standards, which you have knowledgeable parties in an arm's length transactions. Impairment loss is when the carrying amount of the asset is less than the amount at which the carrying amount is more than the net selling price. Say for example, I have carrying the asset at 100 rupees, whereas I can sell the asset in the market at only 80 rupees. The 20 rupees is called impairment loss. The carrying amount is whatever is there in the books, like in my example 100 rupees. So when to recognize an intangible asset? The intangible asset should be an identifiable asset. How you identify an intangible asset, which means you have a patent registered, copyright registered. Is it always necessary for you to have a legal substance or a legal enforceability? Might not be, but mostly it should be there. Then only it is identifiable asset. It is a non-monetary asset, so it is not like immediately like you cannot convert it into cash immediately, so it's a non-monetary asset. So it's without physical substance, used for production, supply or service. You will be using for production, supply or service. So you should control it. You should control, as I told, it is in line with identifiable. Control means that future economic benefit, which means the flow of cash from that asset should flow to you, basically. So basically a future economic benefit means you should get the benefit from that asset. Benefit, when I say, is it revenue? If you ask me, not only revenue, even cost savings. The cost savings also considered as a future economic benefit. Say for example, I have seen a software industry which uses which uses automatic tracker of the HR master. So when you go for interview, you have to fill in the details by yourself. It will automatically create its master. So it saves an employee cost. There are 20 employees working in HR department. All those employees costs are saved. Now the user is actually they themselves entering their data instead of one guy sitting and entering the entire biodata of that staff who is coming for the interview, who is going to get recruited. So instead it is already available in a template. It is already automatically getting populated and saved as the master data. So even so why I am trying to tell this example is that it is not only future economic benefit, means it something should flow to you. It also consists the cost savings which you need to consider and consider as a future economic benefits. Though you should be able to measure the cost reliably, and in case of amalgamation, say for example, you would have seen amalgamation AS14, you would have done more sums. Practically, if you see, there are some intangibles which is coming out of amalgamation that are not measurable. Say for example, are not usable or not identifiable, then you should not recognize as an intangible asset. You should so the difference between both net assets and the purchase consideration goes to goodwill. So it has to be removed from the net asset and shown as a goodwill, because the difference will increase. The difference will totally goes to goodwill. So separate acquisition. So separate acquisition means you have separately purchased. It's a purchased intangible. So purchased intangible is very simple. The cost you recognize as an intangible is cost to recognize is the cost which comes from the invoice, directly attributable cost, other directly attributable like interest on borrowing cost, etc. If you have it takes substantial period of time to get installed, and other costs incur in connection with the particular intangible asset, which are directly relating to that intangible asset. So acquisition of by government grant, it is very simple. Please reduce the cost of the assets, or whatever as per AS12 you need to follow. Exchange of assets means so you have to take the fair value which is more relevant, either the securities issued or the fair value of the assets you got. Internally generated goodwill. Internally generated goodwill normally you should not recognize. So again, internally generated intangible assets. So again, internally generated intangible asset, the standard deal little detail in that. They just recognize like research. They classify internally generated goodwill, internally generated intangible asset into two phases: research and development phase. So if research and development, why they classify into research and development phase? Research phase, whatever expenditure you incur might not get capitalized if you not passed on to development stage. Meaning you just analyzed, you did a feasibility study whether I can develop this software or not. So those expenditure, if the ultimately that software research got failed, then those expenses has to be debited to the profit and loss account rather than capitalizing as a intangible asset. So you should succeed in that developing software. So you should move to development stage. So research and development expenditure put together should get capitalized. Research and expenditure alone cannot get capitalized. It has to be charged to the profit and loss account. So subsequently I am incurring expenditure. Subsequently I am incurring expenditure for maintaining that intangible asset. How to deal with that expenditure? The standard again says, are you getting future economic benefits more, and is there any efficiency involved? Then you should capitalize. Otherwise it has to be charged off to the profit and loss accounts. So you should get more economic benefits, and the cost you should be measurable, etc. Then it should be you can capitalize that asset. Amortization period, you should amortization period, again the standard says maximum allowed for an intangible asset and in India is 10 years. If you are going to it is not necessary that you keep 10 years for all assets. So it's, say for example, some license maybe you have purchased for 2 years, so you have to amortize over 2 years. So if maximum there might be indefinite licenses also. Those indefinite period you can have a licenses also. So those licenses has to be depreciated or amortized over 10 years. So you cannot amortize more than 10 years if you are using but there are no strict hard and fast rule. You can amortize more than 10 years, but you have to give clear explanation in your financial statement why you believe these intangible assets can be used more than 10 years. Impairment loss, as I told you, you have to always evaluate impairment, because technology always goes, because we can see today every week one model mobile comes. So the asset used to produce the older models gets wasted. You have to impair it. So the assets which are useful life of 10 years is getting you have to impair it now itself, because the technology is no more useful. The mobiles technology which you use, so those things you keep seeing, you keep assess whether any impairment loss is there, whether you have any active market for this model. If you don't have, then you have to impair it. So disclosure requirement, you are supposed to disclose useful life, amortization method in the sense you can either straight line method you can adopt, or any other quantity based you can adopt based on number of application, its processes, etc. So amortization method, it's your choice, but you have to disclose the then gross book value and accumulated depreciation we have to disclose, and the reconciliation of what is the opening balance, additional during the year, deletions during the years, and closing balance we have to disclose. And as I told you, if it is greater than 10 years, we are supposed to disclose why we believe that it can be used for more than 10 years. ABC Limited developed know-how by incurring expenditure of 20 lakh. The know-how was used by the company from 1/4/2000. Useful life is 10 years. From the year of commencement of its use, the company has not amassed this asset till 31/3/2016. Past journal entry to give effect to the value of know-how asset. So what you do is, for the first 7 years you have to debit to the profit and loss account, like reserves and surplus. The balance from the 8th year onwards, it can be charged to current year. So it is just simple. So the company not adopted intangible asset, they have not amortized the asset, so it's an error in the profit and loss account. The error the company had made. So first 7 years of depreciation has to be charged to the reserves and surplus. The balance 3 year can be charged now, meaning from 8th year onwards you can charge it to the profit and loss account. The balance opening has to be charged to the opening reserves and surplus, which is a profit and loss account as a prior period item. The company had spent 45 lakhs on publicity and research expenses on one of its new consumer products, which was marketed in the accounting year 2015, but proved to be a failure. Please underline this word, failure. So this 45 lakhs has to be charged as an expense. As I told you, it is a research expenditure. So anything which are in research expenditure has to be expensed off. The company with a turnover of 250 crores and an annual advertising budget of 2 crores has taken up the marketing of a new product. It was estimated that the company would have a turnover of 25 crore from the new product. The company has debited to its profit and loss account the total expenditure of 2 crore incurred on extensive special initial advertisement campaign for the new product. So this again, as I told you, it no need to be a inflow to you from an intangible asset. It can be also a cost saving. So this is considered as a cost saving because I have incurred 2 crores but I have generated 25 crore revenue. So say for example, this 25 crore revenue, if you are able to estimate that the economic benefit you got out of this 20 crore is more than 2 crore, you can recognize as this 2 crore as a intangible asset in the books. So you have to analyze the future economic benefit. So in this question, you can recognize 2 crore as an intangible asset. You are not supposed to debit to the profit and loss account. Okay, that's all from AS 26. So we are moving to the last standard for the day, so which is AS 29, which is provisions, contingencies, liability and contingent assets. Before getting into the standards, I like to briefly summarize this standard. So this standard basically deals with three concepts. One is probable, possible, remote. In case you have probable exposure, you have to create a provision in the books. Say any kind of litigations. Possible, you have to create a contingent liability. Remote, no need to do anything. Contingent liability means you would have seen the financial statement or you read any annual report. You can see a separate footnote to the financial statement called contingent liability. There they would have listed all their cases, all their litigation, indirect tax litigation, direct tax litigation or any other litigation for that matter. They would have seen why the company believes they will win this case. So those cases are called contingent, possible cases, that's a contingent liability. So you deal with probable, possible and remote. Probable means the event is going to happen. It's a probable, so you have to create a provision. In case of possible scenario, you are not sure still, but you know the amount, but you are not still, there are chances that you will win as well. So as of now you don't know, so it may or may not change, but depends on the future happening of some uncertain events. So as of now you can keep it as a contingent liability, because you are, as of now you are sure that you will win, or sure that you 50-60% you will win, so you will keep it as a contingent liability. And remote, remote means you are 100% sure that you will win, no need to disclose anything. So just this is the broad concept based on which this standard was dealt with. You have to be careful in analyzing whether to create provision, or we have to show just as a contingent liability, or we no need to do anything in the financial statements. So this standard deals with some of the definitions like past event. The past event is nothing but the event which is happening in the past. The obligating event is coming from a past event. The obligating event means something happened, and because of this your obligation got confirmed because of some past event. Like say past event in my example is a litigation. You got a GST notice. Now you are now you have responded to that, but the authorities have not liked your response, or they are not okay with your response. They have raised a demand order. So when you received a demand order, again it becomes an obligating event. Obligating event means it is confirmed now that you have to pay demand. Though you are arguing in the court of law, you have a weak, your lawyer told we are having a weak position, then it is an obligating event to create provision. So the past events gets confirmed, it's become an obligating event. And we will also see in case of reimbursement what we can do. In case of estimate, so how to estimate? Estimate means always the provisions require substantial estimate, whether how much you will win, 60% you will win, how much to create provision for, how much to disclose it contingent liability for, etc. Those are all estimates, judgments. So outflow means if it is probable that outflow is confirmed, you have to create provision. Outflow means just nothing but you are going to make payment. So present obligation means I have now the present obligation. Say in my case of GST notice, it is confirmed and your lawyer also have confirmed. Now there is a notice, now there is a present obligation to pay. Now how much is to pay? The reliable estimate is there, outflow is confirmed. So present obligation, you are able to measure the cost reliable, and outflow means the expense you are going to incur is confirmed. So you have to create provision. If you are not able to make reliable estimate, though there is a present obligation, but you are not knowing the liability, then it is a contingent liability. Though there is a present obligation, there is a outflow, but you are not able to identify the outflow, then it is a contingent liability, that is a provision. You can read the definition of what is the present obligation or what is the contingent liability, you can understand this. So So the contingent liability definition is there is a present obligation, however the reliable estimate are not able to meet, or outflow is not made, or it is a possible obligation. Contingent liability definition is it is a possible obligation, which means the happening of the event is uncertain now, it might confirmed in future based on some uncertain events which is going to happen, or it is a present obligation, obligation is there but I am not able to measure reliably, and outflow I don't know. So how much outflow I don't know. That is called contingent liability. But if it is your probable means present, but if it is a provision you have to create, then what do you mean by provision? You have a present obligation, your reliable estimate is there, and your outflow is confirmed. You have to create provision, which means probable situation. It is a probable situation. When the present obligation is there, reliable estimate is made, and outflow is also confirmed, it is probable. When there is a possible obligation, it is a contingent liability. When there is a remote possibility, then there is a remote chance, so you no need to do anything. So possible obligation not within the control of the entity, anytime anything might happen. So as of now I have shown as a contingent liability. Contingent liability typical example may be also a holding company given guarantee to a loan taken by a subsidiary. As of now you don't know whether subsidiary will fail or don't fail, but it will so it get confirmed only on the happening of some unforeseen events in the future. So as of now I have to show as a contingent liability and disclose all the facts, what I have done, what might be the liability, etc. So existence of the obligable, this is provision. Existence of an obligation balance sheet date is probable. Setting this obligation good results in the outflow of resources. Quantum of liability measured by using substantial degree of estimate or be able to make provision to be recognized in the balance sheet. So what is the disclosure requirements? Details of movement of each clause of provision. Example, warranty, gratuity, bonus, everything is a provision, and litigation. So what is the opening provision you created, what is the provision created during the year, and what is the provision reversed during the year because you have closed some of the cases. So all those things you have to be disclosed. Contingent liability, existence of the obligation is not probable. Existence of the obligation will be confirmed by one or more future uncertain event that may or may not occur. Amount cannot be estimated reliably, then it's shown as a contingent liability, which we have shown in the chart itself. Contingent liabilities assets or not, so the standard also deals with contingent assets, but it's not relevant. Contingent liability and contingent assets definition is more or less similar, just an opposite definition. So as I told you, the standard deals with three situations: probable, possible, and remote. No adjustment required, contingent liability, and it has to be recognized in the books as a provision. So disclosure requirement, movement. This standard is not applicable for an SMC company. Uncertainties, if there are any uncertainties, say for example you have to disclose as a contingent liability, but there are maximum uncertainty involved, why you are not able to disclose the amount of that contingent liability, you need to disclose, and timing of the outflow you need to disclose, nature of the contingent liability, whether it is a bank guarantee or a GST liability or income tax liability, based on the whatever it is you have to disclose. So here we have the questions. Please go through these questions. I will just have some more time. So in case you can see from the company has 20 cases. Out of 20 cases, 5 cases the company's probability is 100% they will win, but the next 10 cases if you see they will win 30%. Chances of next win cases is 60% chance of winning. So in case you have 100% chance of winning, it is it's a remote chance. When you have win percentage of 60%, it is possible, which means you have to disclose as a contingent liability. When the win is 0%, then it is a present obligation, you have to recognize as a provision. Only thing is that you should be able to measure the cost, outflow, etc. Then it is a provision. Here their win percent is 60%, not 0%, 60%. So this case it is a contingent liability. So how much contingent liability to be recognized? So you have to just multiply by 1,20,000 into 30% damage for each case for 10 cases. So remaining 5 cases, 50% chance. So 50% chance also a possible. So it is a contingent liability. You have to show us a contingent liability. If it is a 0%, you have to recognize a provision. 0% recognizes a provision. So how to calculate the contingent liability? 1,20,000 30 and 20 lakhs into 10%. Like that, low damages 1 lakh into 30% to 2,10,000 into. So this is how the contingent liability to be calculated. Hope it is clear. I am just moving on to the next one. So for each case, that is, so into 10 and into 5. EOX Limited is in the process of finalizing its accounts for the year ended 31st March 2017. The company seeks your advice on the following. The company's sales tax assessment. So they have got a demand of 2.76 crores and they have so the company paid the entire due under protest, and means they had deposited already to its appeal. The company files its appeal before the appeal, wherein the grounds of appeal cover tax on additions made in the assess. So they have filed appeal itself to amounting to 2.10 only. The remaining amount they have not even gone for the appeal, which means they are sure that they will lose, which means there is a present obligations, and amount also able to estimate, and the outflow also we know how much is the amount. So 2.76 minus 2.10 is a provision. 2.10 is a contingent liability, because you are going to appeal, still there is a possible obligation, you may or may not lose. So it is a contingent liability. So to answer this question, you are supposed to write what is a present obligation, what is a possible obligations, and why are you considering this as a present obligation and possible obligations. So the company has entered into a wage agreement in May 2017, whereby the labor union has accepted a revision in the wage from June 2016. The agreement provided that the hike till May 17 will not be paid to the employees, but will be settled to them at the time of retirement. So company agrees to deposit the arrears in the government by September 2017. Again, the liability got confirmed, so it is a present obligation. It is a prudence concept you have to recognize immediately. So that's all from the standards. So thanks for attending this seminar. If you have any queries, you can always reach out to me. My mobile numbers and my mail IDs are here. So thank you for watching this video, and thanks for again for Sivakasi branch of ICI for giving me this opportunity. Thank you.